It's a funny old time on markets at the moment. It does feel at times that we're just one move away from a potential full-blown economic meltdown. This past week, a lot of that uncertainty surrounded Credit Suisse. Now, for those who haven't been following the story, Credit Suisse, one of the leading global investment banks, its share price was down by over 12% in a single session. Its credit default swaps have been soaring. We'll talk about what that means in this video. And its CEO sent out a memo, which sent shivers down the Twitter sphere, as well as global markets. There's a lot of uncertainty. The question that investors and analysts are now asking, is this the start of a GFC 2.0? Will an investment bank failing lead to another financial crisis? Is this a potential Lehman moment? Or is this something that we're going to move past, it'll be in the rear view in the not too distant future, and we're able to get back to business as usual? We're going to unpack it all. As we go through, drop in a comment. I'd love to know your thoughts because it's definitely an evolving situation. To understand the story, we have to think about the CEO memo that the Credit Suisse CEO recently put out. He talked about the strong capital position, their liquidity position as well, and he stated that yes, it's a critical moment, but essentially there's nothing to worry about. However, of course, as I'm sure we all know, when someone says there's nothing to worry about, don't look here, no stress, it's obviously going to draw a lot of attention and eyes. We're trying to work out what's going on. And that's essentially what happened over the weekend. Twitter went into meltdown, the Reddit boards were streaming, apparently the Credit Suisse executives were on the phone to potential investors, talking to their largest clients, trying to reassure them that there was nothing to worry about. Of course, we needed to try and work out where the fiction is and where the truth is. And as always, the truth's going to lie somewhere in the middle. Now, this manic weekend ended up culminating in a Monday session where the Credit Suisse share price ended up down by as much as 12%. Investors were running for the exits. There was a lot of fear, but it is worth noting that Credit Suisse's share price actually ended up turning around, which is fascinating to reflect on. A lot of the wording and the comparison has come through from the CEO's memo and note about their strong capital position, and some other ones in the past, such as Lehmann Brothers CEO, who 4 days below their collapse put out a similar type of discussion, or the Bear Stearns CFO just a couple of weeks before talking about their strong capital position. Now, of course, this is not to say that history is going to repeat itself, but it is driving a lot of the uncertainty that we're seeing play out on the markets. And so before we discuss the key reason for Credit Suisse's share price collapse, we've really got to understand where Credit Suisse is currently positioned. So year to date, it's down by around 60%. As we mentioned, its share price was down by as much as 12% at the worst of it in a single session. At times, its share price has been trading more like a penny stock, despite the fact that this is a leading global investment bank and it's a blue chip. Of course, when we're thinking about it, going back to 2007, the peak prior to the GFC, Credit Suisse has lost nearly 90% of its share price value. And it has, even just over this past period, been involved in a range of different uncertainties and scandals. Some you might be familiar with if you've been watching the news include the Green Seal collapse that Credit Suisse had exposure to, the Archegos collapse, Credit Suisse took nearly a $5 billion loss on that one, the Mozambique tuna bond scandal as well. There's a lot of uncertainties, and just to give you that insight into the current market perception of where current Credit Suisse is currently positioned, it's currently trading at 0.2 times price to book. And so then that leads us to everything that's played out over this past week, with Credit Suisse's CDS spread soaring, sending genuine shockwaves throughout the markets and fears about a potential global financial crisis 2.0 with the comparisons. But to understand it, we've got to understand what CDSs are. So credit default swaps, they essentially act as insurance on the risk of a company defaulting on its bond. So the spread gives us a proxy insight into the market sentiment of the risk with the cost to insure its bonds. And so, over this past week, we saw Credit Suisse's CDSs soar by over 300 basis points at the peak of the run-up. This, of course, is inconvenient for new funding costs, as well as the possibility of bringing in new money. But it is worth noting as well on the other side that Credit Suisse does have a relatively high CET ratio of over 13%, and it's got a relatively high liquidity coverage ratio of over 190% in comparison to many of its other peers. Of course, intuitively, that leads us to the question of what happens from here? I'd love to know your thoughts, so drop in a comment, let us know what you've made of this situation as it continues to evolve. However, for Credit Suisse, we've got a clearly defined milestone in the near term to look towards. They're currently undergoing a strategic review. They've got a planned date for the end of October to provide that review and give an insight into any potential restructure or how an overhaul could look. Of course, there's talks about a potential split out or what could flow of that. There's a lot of speculation at this stage, but the end of October will give us that understanding. It is worth noting, however, if there is an associated capital raised with that via equity, obviously the further the share price falls, the more dilutive that could become. And so the market continues to ask itself, is this a potential Lehman moment, the start of a GFC 2.0? Or will Credit Suisse emerge from this relatively unscathed and heading into a new chapter? Firstly, if you haven't yet, make sure you've subscribed and turn your bell notifications on. We'll leave a link after this one that you can check out with another video if you want to continue to explore the markets. There are a few important considerations, however, when we consider the question. Firstly, on the credit default swaps note, it's worth considering the fact that this is not the first time they've run up. Prominent examples include Deutsche Bank in 2016 or Morgan Stanley in 2011-12. Of course, in 2008 as well with the GFC CDS's Soared. However, the risk of potential contagion and whether this is isolated to Credit Suisse or more systemic is one that will continue to reverberate around. Of course, if it has a risk of contagion, what's going to happen if Credit Suisse hypothetically cannot meet its obligations? Will it be allowed to fail, or will it be bailed out, potentially by the Swiss Central Bank or the European Central Bank? Of course, the end of October is not too far away. Investors and analysts are eagerly awaiting the strategic review to make some more decisions, but there could be news between now and then, and we'll definitely keep you updated if so. A big thank you for joining us. Check out another video. For now, stay well and happy investing.